by way of introduction, my name is John Wallace. I'm an equities manager here at Jupiter, but in principle, with a focus on environmental solutions equities. That means I manage the Jupiter Ecology Fund and a couple of other funds around that. But I'm principally interested in talking to you about the Jupiter Green Investment Trust, which is a fund and a trust, I should say, that we are particularly excited about at this point. Also, just I guess by way of background, my academic background is in environmental technologies, something that is obviously very pertinent to where we're investing. But I should say that was about, well over 10 years ago. I joined Jupiter in 2009. So although there is a lot of hype and hyperbole around the space of green investment and environmental solutions investment and sustainability more broadly, I'm definitely not someone who's jumping on the bandwagon, if that makes sense. And also Jupiter themselves as a business, as you will know, I'm sure many of you have been investing in this space since the late 80s, since 1988. So we're very proud of that heritage, and we also think that experience really does count. I will bring you on to the next slide just to check that, Chris, that these slides are working. Yeah, I think they are.
Yeah, that's fine. That's fine, John.
That's fine. Okay, let me just move this. So just because I can't see my slides, I'm just going to bring them back from my paper. 1 second, my paper copy, so I don't lose my natural place. But I guess hopefully you can see there the first slide, which is the key features of the investment trust. And I really want to draw your attention to a couple of key ones, which I'm going to focus on this evening. Firstly, really what this trust is all about. We're looking for companies which enable environmental transition. What I mean by that are these are companies which have a product or a service which is really focused on an environmental solution to an environmental challenge. And that's really key. I will place that in the wider context of environmental solutions investing for our listeners, for our joiners this evening. Also, I think a key feature here, as I mentioned with the investment trust, as it compares to other funds that we manage here, is actually the size. The size is relatively small at £60 million, 60 million sterling. And actually that is really a virtue, I think, especially in the market as we find it today, in the landscape that we have for investing in this area. I will touch on why that is with some good case studies, I think, and why that's going to be increasingly important going forwards as well. But naturally, I think another key feature here is that we are focused on small and mid-cap companies, which I think alludes to why I think this is an important area and a good reason to be. They'll have the ability to invest quite flexibly in the small and mid-cap space, which is where we're seeing a lot of exciting innovation and really, really important innovation as well, which I'll be touching on in more detail. I mentioned the landscape for sustainable investment, and this slide hopefully shows you, I guess, breaks down the overall of different approaches and the varying approaches. And we heard from some of the speakers previously tonight about ESG and what that means. For us, really, we are part of the sustainable investment landscape, but a very specific part of that. So we're looking for sustainable themes. We're looking for environmental themes in particular, and companies which meet those themes mean that they are providing a solution that's really the core of their business. So typically 50% or more of their business, of their revenues, are coming from a very recognizable environmental solution. That frankly is important in terms of focusing our time and attention in the global equities universe on those companies which we think are best placed to benefit from the focus on tackling environmental challenges. But also it's important to differentiate the trust from what we're not doing. So what this means is we're not excluding a small portion of the investment universe on ethical grounds, and then potentially investing in anything else apart from, you said, a tobacco company. We're also not looking to invest in the best-in-class sort of companies, and that means that we're not looking to invest in companies which are performing better than their peers, but could be in any sector, be it tobacco, etc., or banks or healthcare companies, for example. We're very much focused on companies which we think are best placed to meet environmental challenges with their products and services. That means that the themes really dominate our way of thinking, and they dominate how we build our universe, and everything really flows from that. Just to change slide and to focus on the individual themes here. So firstly, this gives you a flavour of the fact that we're not just a clean energy fund or a water fund, for example, or even a circular economy fund, but actually we are focused on effectively all of the major environmental solution themes that really matter. So we think if we can see meaningful deployment of the solutions across these areas, then we will be able to, as an economy and as a society, be able to deliver on the big picture global environmental goals that we have. And COP26, or the climate conference, recently was just part of that overall picture. As part of the landscape that we're looking to invest in and find solutions towards. But also from an investment management perspective, and we say this from experience, we find it very, very important indeed that we can focus not just on one of these themes, but across the 6 themes that you see there on this slide. The reason for that simply is that some of these themes can perform very well at times, but also not so well and fall out of favour. And I think having the optionality to invest across these themes is therefore a real driver and real value add for our clients. I'm just going to pause there and just change my screen so I can check that you are looking at the same slides. Good, you are. That's great. So onwards from there. Apologies, 1 second. Sorry, we're all having technical gremlins this evening. So or maybe a case study about how we start to think and build our investment cases and understand what we're looking for from our investment universe. And I want to draw on the climate area, if you like, so we're building on the recent news flow that I'm sure you all have seen from the COP26 conference in Glasgow. A lot of time and attention is focused on decarbonising the power grid, so how we make energy, how we store energy, how we distribute it as well, and also in areas of transportation, so electric vehicles being a key area at the moment, and a key focus point, not just in the media, but also in investment markets as well. That, I think, is quite kind of understandable. I think these are large parts of the economy that we do absolutely need to decarbonise and address quite quickly and urgently. But actually, as you can see here on this slide, they're only a relatively small part of the overall picture. So the power, this is a global environmental picture, by the way, in terms of global carbon emissions or greenhouse gas emissions. About 1/3 of that's coming from power or power generation, and about 17%, as you can see, is coming from transport. That leaves whole tranches of the economy, so industrial sectors and agriculture sectors in particular, largely untouched, and that's really where we face what we face up to today. These are sectors that are quite difficult to tackle. Not to say that power and transport are easy to tackle, not by any means, but agriculture and industrial sectors are, I think, in many cases notoriously difficult to address from a climate change perspective, but we absolutely do need to in order to deliver on those goals of net zero, which was firmly re-established coming out on the back of the COP26 climate conference. I suppose if we can be more positive about that, and here I come with my sort of optimistic hat on my environmental technology kind of thinking around this and my solutions-led thinking around this, actually about 2/3 of the emissions gap that we need to get in order to get to net zero and net zero economy globally, it's about around 2/3 of that, and this is some research that came from Boston Consulting Group, can be delivered with existing technologies. So this reminds me very much of the quote that the future's already here, it's just very thinly or very unevenly distributed, and I think that's very pertinent in this particular topic area. So think about the everyday solutions that we have. It might be energy efficient light bulbs, for example, or insulation in our homes. So these are quite well established technologies or solutions. There's also clearly much more recent solutions as well around it, and I mentioned electric vehicles already, but these are only a very small part of the overall investment landscape. But these technologies do exist. They are commercially available, commercially scalable, and ready to go. What we need to do is to ramp up the deployment of these solutions more rapidly and more quickly. That's why we're excited about the overall investment thesis for investing in environmental solutions companies. We do think they will outgrow the wider investment market because they are, I think, expected to become, certainly not in our perspective, more central, more prominent, and grow more quickly in their own individual markets. So in order to take share and therefore outperform, we also think that they offer a good ground for finding investment outperformance longer term. This also speaks slightly to how we think about breaking down our investment landscape as well. So I will come on to the remaining innovation gap later, but just for now, I want to take you through how we think about individual companies. We break down our investment landscape into these three categories of companies that you see here. So innovators, accelerators, and established leaders. But before I talk through those individual areas, I wanted to highlight a quote recently that caught my attention from Larry Fink of BlackRock, a rival fund manager. But I think this is a really pertinent quote at this point. I think hopefully you can all read that, but he said essentially it's his belief that the next 1,000 unicorns, so that the next $1 billion or companies which are worth $1 billion or more, are going to not come from the traditional tech sector, not necessarily a media sector either, but really come from companies that are developing the solutions to those large industrial sectors and agricultural sectors, for example, that have as yet not made a significant amount of progress in tackling their underlying environmental footprint. And clearly they need to do that very urgently. And that kind of informs some of our thinking a little bit, or certainly chimes with our thinking, which is that we need to see a rapid scale up in innovation. So to fill in that gap, that remaining gap in the emissions slide that I mentioned on the previous slide, but also to accelerate, and this talks to the accelerators here, the deployment of solutions which are already existing but not widely distributed yet. So if we tend to think about how any technology finds its marketplace, it tends to go through an S-curve. Relatively small market penetration at first, and then a rapid ramp up of scale of deployment as the market becomes open and becomes more mainstream. And we see this time and time again in technologies, not just environmental technologies and solutions, but in everyday products and items as well. Interestingly, that whole process of how technologies become more diffuse in an economy is only getting quicker. So maybe just to add some color with those kind of categories of companies that I mentioned earlier. Thank you. That's the perfect slide. Apologies to everybody for the technical difficulty there. Some I guess high level examples that we have in the portfolio today, and these speak definitely to both those innovative and accelerating companies, of which together that whole category of company, if you like, is expected to be and is currently around 70% of the portfolio. We typically guide to our shareholders for the trust that the range will be around 70 and 75%. With it, what that means is we have a leaning towards growth companies in this space, but also including a relatively high share compared to the other funds that we manage here in that innovative category. On the left-hand side here, what you can see is a Swedish company called RenewCell. Not a company that you'll know by name, I'm sure, but their product or their underlying technology here is a product called Circulose, which is trademarked and is available in stores already through Levi's jeans or pairs of Levi's jeans, and also a lot of H&M products in selected markets. This is a fully recycled textile. So it's the only commercial scale recycler of textiles globally. The reason why this is important within the wider environmental picture is that means that we're saving huge amounts of water. Also how we use land and land use issues there was a solution for that as well. But also from a carbon perspective, this is some work the company has done with their key partners here and their supply chain partners. They're partly owned as well, I should mention, by the likes of H&M, the H&M Group. So as well as being a client, they're also a shareholder and are locked into a long-term shareholder agreement with this company. But with those partners, they've been able to work out that actually they have, on balance, a net positive climate impact from recycling garments that are often unsold and would otherwise be going to landfill or to incineration. And as a result of recycling that product and placing it back into existing supply chains, so companies in the textile sector, for example, don't need to retool or do anything significant to be able to use this material on a cost competitive basis. So as a result of all of that, they actually have a net positive climate impact, and that's really important when we think about that chart that I showed you earlier, and hopefully you could see it. That showed you the net impacts of the sectors outside of the power sector and outside of the outside of the transport sector as well. So this is one of those areas of the wider economy that we think is absolutely going to be front and center of popular thinking, also government regulation as well. So partly driven by the climate change regulation coming in, we're also seeing waste regulation, meaning that the companies like H&M, like a Levi's, won't be able to dispose of unsold garments through landfill or incineration, but that's happening by the next several years in the European Union. So that's a real powerful driver for this company. the key reason why I use this one as a good example for us, it's actually quite a high holding for us in the portfolio. It's not top 10, it's slightly outside the top 10, but it is, as you can see, a relatively small market cap for us compared to the rest of our investment universe. So 600 million sterling market cap. We bought this company on IPO late last year when it was around about a 300 million pound company. So it's performed well from a shareholder returns perspective, but still, I guess, from an investability perspective for the funds that I manage, to be able to, or being able to access this sort of company at scale where it can make a meaningful difference to portfolio returns is frankly more difficult when we're dealing with a larger fund. So I mentioned that the size of the trust is a virtue, and that's a good example here of why I say that. The next example, and I'll be fairly quick with this one, on the right-hand side, is a slightly larger company, so almost a $2 billion company in sterling terms, a Norwegian listed company, very old company as compared to RenewCell, but has gone through a couple of reinventions in the last several years. This is a company which can take wood waste and transfer that into products which can basically substitute petrochemicals in everyday products. That includes flavoring, packaging materials, also everyday cosmetic thickeners and that sort of material that basically gives them a very large addressable market. They can choose where they will sell that product in towards, and that's effectively giving them a significant earnings uplift as a result of that. And the example I've given here in terms of the impact of this particular stock, of this company, but also its products in their marketplaces, the example here is for the nutrition business. So about 9/10 of vanilla flavoring that's used globally is actually synthetic. It's called vanillin. So if you ever read the back of a packet of anything that has vanilla in it, vanillin effectively means synthetic, and that means man-made rather than the naturally occurring ingredient, of which about 85% of that market is based on petrochemicals, and that sounds particularly kind of unsavory. And also, if you have a large consumer goods company that wants to have clean label products, so healthy, naturally occurring ingredients in that product, and also have a carbon target to become net zero at some point in the future, then you're going to be starting to think about the carbon footprint of the ingredients that you're putting into your everyday products, how that's transported, etc., and what happens to that product at the end of its life. And this is a good example of I think, an overseen part of the investment landscape here. So it's not all about energy markets and transport markets. There is a very wide and growing and differentiated end market for this type of environmental solution that we think is why it pays to be a specialist and focused on environmental solutions markets, and to be looking for this type of opportunity, which frankly is often quite overlooked. And on top of that, it's a benefit for us to have an investment vehicle in the Jupiter Green Investment Trust, which can get meaningful exposure to some of these smaller and mid-cap names that I think have a very strong growth credential and growth pathway ahead of them. If I could just turn to the next slide, please, and I will keep it fairly brief. I think we are now sort of running out of time, but from an investment process perspective, I guess the key highlight here is that we have about 1,200 companies globally in our investment universe. Typically, actually, what we're doing is tracking on a nearer term basis around 300 of those names. A key driver for that is a combination of bottom-up research, but also that top-down thematic insight that we have as specialists in this space. So knowing what a consumer goods company is looking for in the marketplaces, and like that might be a H&M, or it might be a Unilever as an example of that. Knowing exactly what they're looking for and understanding what companies can provide the solutions to that, given the two examples I've just talked through, gives us that thematic insight that really does influence our bottom-up investment analysis and research around that. If I can turn to the next slide, please. I just want to touch on actually, let's skip a couple of slides. If we go to the performance slide, I guess in the interest of time, which is the following slide. Thank you. A key line that we've drawn here on this chart, this is a 5-year chart, but you've got 1 and 3 year performance numbers above that, is recognizing a change that we brought into the trust around the September mark last year. And that was on the back of coming out of the real depths of the COVID crisis, and in recognition of the fact that as compared to the previous global economic crisis, when I joined the business in 2009, or in that sort of period, the shape of the recovery and the flavour and the I guess the colour of the recovery and the recovery plans have clearly a very strong environmental and social flavour to them. So we think that when we see Build Back Better plans, for example, in the US and in the UK, actually what that means often is build back greener. And given the conviction that we have in the very long term, but now as well in the short term and medium term, we think that this is transformational for our overall investment landscape, and that the innovation that we've been talking about, which might have a 5 or 10 year market horizon to it, is actually much nearer term now. And as a result of that, both myself and the board of the JGC Green Investment Trust have repositioned the trust to take advantage of that change in landscape, which has meant reducing the emphasis on providing a sustainable dividend yield and a growing yield, and to focus instead on smaller innovative companies with a growth agenda, to have a total return approach rather than a targeted yield approach, and also to make better use of the credentials for the investment trust too, which includes gearing and the use of potentially private market opportunities as well in that innovative space. And since then, I think performance has been, as you would expect, relatively volatile compared to the previous approach to the investment trust. But in the long term, we think this is absolutely the right strategy for the trust and will mark a very compelling investment for our shareholders. I will just turn to my summary slide there, which is to, I guess, to recap, if I can, on the next slide. Thank you. The changing landscape that coming out of COVID-19, I wouldn't say we're fully out of it yet, given the recent news, but since COVID-19, the landscape for sustainable environmental investment has been strengthened rather than diluted, and that's exactly what happened in 2009. It's a night and day difference, and we see very strong reasons to have that conviction that our end markets for the companies we're looking at are in very, very good shape. Secondly, the focus and the need for innovation, if we're going to meet the long-term, big picture global environmental challenges that I think are really of the now, and clearly they are era defining, I think, in so many ways. And it's partly a reflection of that, the third point, that the trust here has an evolved approach to investing in this landscape to make better use of its natural attributes that I mentioned earlier, including its size, relative size, and its flexibility to access a lot of the innovation in our space, and to capture those long-term structural investment opportunities that we have high conviction in. And with that, I will hand over to any questions.
What is the portfolio turnover, and when do you sell a company?
Sure. So turnover is about 20%. So it's relative. I mean, we have a very long-term investment horizon, but I think what's happening at the moment as well is partly because of the change in the nature of the trust. The turnover has ticked up a little bit, but also if I look ahead, I expect that we will be seeing a slightly higher rate of turnover just by the fact that we're seeing quite a lot of movement in the underlying investment theme. So as we're moving the trust to take advantage of where we think there are underappreciated opportunities, but also taking profits from those opportunities that we think have got less upside potential, then as a consequence of that, the turnover will go up. When we sell a company, fundamentally, if something changes to its end markets, I don't like when management changes in quick succession, if you see lots of corporate governance changes, for example. We also sell clearly on valuation grounds, and I think that point I made previously about the landscape moving quite quickly. You know, we are seeing companies in some of our themes running quite hot, and we've taken profits from those companies and sold out of those companies as a result, and redeployed that in those themes that we think, frankly, are not as widely looked at, and where we could find better opportunities.
Okay. The discount is about 2.5%. If that starts to widen, are there any discount control measures in place, and what are they?
Yeah, we have a proactive approach to manage the discount, which means buying back shares when we see it appropriate. Actually, the trust has been trading at a premium at various points this year, but has traded a discount more recently. So, you know, for many of our clients or potential clients and shareholders, that's an opportunity to get exposure to this trust or to add exposure to this trust. For others, actually, they prefer to buy when it is at a premium. So it's not, I guess, always clear what our shareholders want, but when we see a discount widening, then we have the mechanism in place to buy back shares and to reduce that discount.
Okay, got time to squeeze in one more. Do you meet companies face to face, and how important is management to you?
It's absolutely central. I mean, it couldn't really be more important. I think. I mean, you've heard from the previous speakers today how important it is for their businesses to be completely passionate and focused on their businesses. That's the same for us. So strategy is all important, but the management and the culture of the management team is also absolutely vital. And I've alluded to that as well when I mentioned reasons why we often sell. The company I mentioned before, just a quick example, but Borregaard, the reason why we added to that position quite significantly was that the CEO didn't have to leave. So this was a Norwegian company where you have to retire in some cases at 65. He's a 63-year-old guy who I think is going to be very important to the business. His CFO is also 63. I don't want those two seats changing in quick succession. So it is vital for me. Seeing companies has obviously been much more difficult until recently. The company that I mentioned before, Renewcell, I'm actually in Sweden in 2 weeks' time on the site visit for one of their sites. So the world is slowly opening up again. But this sort of format, in most cases, with the occasional technical glitch, that side we've been able to keep in regular contact with management teams.
Excellent. Okay, John, I think we're pretty much over time now, but just to let everybody know, the slide decks will be nicely cleaned up and you'll be able to see the slides in full, and we'll be sending them to you with John's approval. And thank you, John.
Much appreciated, Chris. Thanks for the patience there.